Good afternoon. Welcome to the 8th edition of the FII here in Riyadh, and thank you very much for joining us. I know it's been a long day, so this session will discuss the impact of rising private debt markets. Let me introduce myself first. My name is Nadine Hani. I present the business news shows on Arabiya Business. We are a pan-Arab news network, and I've been covering this region for the past 20 years, and a lot has happened since then. So it is my pleasure to be here with you today as moderator for this session, which aims to discuss the way that expanding credit markets are transforming finance. According to the IMF, private credit growth grew tenfold in the past 15 years to reach $2.1 trillion in assets and committed capital in 2023. So is this a fundamental shift in the way that we do finance? I will try to address this question to our speakers. This session is divided into two parts. In the first part, we have with us Mr. Glenn August, founder and CEO of Oaktree Advisors, and Mr. Daniel Loeb, CEO and CIO of Third Point, and Mr. Robert O'Leary, co-CEO of Oaktree Capital Management. Gentlemen, thank you very much for taking the time to be here with us, and welcome to Riyadh. Let us start directly with you, Mr. August. We don't have a lot of time, so we're talking about a massive growth in private credit. So can we say that this was the result of low interest rates, which we've had for a very long time, or is this a transformation that is happening?
It's a transformation that's been going on now for the last decade. It really is a combination of the evolving leveraged finance markets. Post-GFC, the banks basically exited the market. The bank loan market became a CLO market. The high yield market became a double B market. And the private equity market became a growth equity market instead of a classic industrial business. As that evolution of the capital markets evolved, and as large asset managers started to raise capital to service the needs of private equity firms, the market exploded. It used to be just a middle market, private debt market, and in the last 5 years, the real explosion has come as private credit has come to the large cap space. And that again is because the syndicated loan market won't buy it because they only do refinancings. There's so much press these days about the banks are back and the golden age of private credit is over. In my humble opinion, that's well inflated and borderline entirely untrue. $900 billion of financing this year in the bank loan market, $600 billion was repricings, $200 billion was refinancings, and only $100 billion was new deals. 85% of all private equity deals get done in the private credit market. For refinancing, that's where it happens. So to me, the trend has happened, continues to happen, the market will double. And the last comment I'd make in the interest of our 20-minute session is that as an investor, the opportunity to generate today 9.5%, 10% unlevered returns, lever those returns 1 to 2 times, make mid-teens types of returns for first dollar risk in multi-billion-dollar companies is an extraordinary opportunity. And I know a lot of people are saying, well, spreads are down, rates are down. The reality is that on a relative value and absolute basis, it's incredibly attractive. So I'm a big believer in the space.
So I can tell you that I do business news shows and have people on the show the whole day asking them where to invest, and private credit is always there. There's a lot of hype about that, especially here in this part of the world. Mr. Loeb, I'd like to hear your point of view as well on what has been said, but also from an investor's point of view today to invest in this space. The potential returns are lucrative, but also what about the associated risks?
What about the, I didn't hear the question.
The associated risks also to investing in that space.
Well, as Glenn pointed out, and by the way, I'm going to take careful notes on everything he said for our marketing deck, because I think he presented a very good overview of this incredible opportunity that exists that he's been involved with for a long time. And we've been investing in credit for 30 years, and mostly in public corporate debt and structured debt. And we realized as of a few years ago, we couldn't continue to only play in those markets because the private credit markets, as Glenn pointed out, have exploded. And if we wanted to be relevant players in credit, we really needed exposure to all of those markets. In terms of the risks, it's, as Glenn also pointed out, you're taking first dollar risk. So the private credit transactions that people do, for the most part, are unitranche deals, 50% LTV. You're getting double-digit unlevered returns or borderline double-digit returns levered up. I feel like the private credit part of the LBO stack is actually where the fulcrum has moved and has the best rate of return, because I'm not even sure the equity below you is going to get the same return. You're taking less risk. So that's one thing. Number two, private credit isn't just unitranche sponsor deals. There's a massive opportunity opening up for credit solutions. So if you think about the $4 or $5 trillion in private equity that's out there stranded, all supporting massive cap stacks, the other opportunity is going to be coming in at senior level, but also at the intermediate levels to increase those returns. So when you ask about, is the risk going up, I feel like despite the competition, you aren't seeing that kind of race to the bottom where people are competing with each other. There's a pretty tight band of where deals are getting done. I haven't seen the return profile degraded, so I think the returns, and we see everything, the return profile and also the volatility profile for the asset class is really good.
Mr. O'Leary, some would argue that it is less regulated than banking. So are you worried about systemic risks, especially in the way it has been exploding, the growth in that sector?
Candidly, I would welcome some systemic risk. I think it would be a lot of fun. It's been a little boring in the markets for the past couple of years, but that's not what you asked. So do I think private credit represents systemic risk? I do not. I think, in fact, if you look at where this risk had historically been housed, it was in the banking system. And the banking system is a flawed sort of structure to have that. It's much more levered. You've got different liquidity requirements. These are lightly levered structures. They're generally locked up, so it's safer. So systemic risks, no. There are other risks. I mean, there are issuer risks where, again, you've got companies that are able to sort of exercise a lot of power in the relationship that they have with the provider of the private credit and maybe get terms that they wouldn't normally or haven't historically. That being said, it's still a very safe product, and I don't foresee anything anytime soon. There is some level of manager risk. The folks to my right are very experienced in this area, but I'm not sure you can say that about everybody in the private credit arena. And candidly, they're set up for performing markets, and when the defaults start to occur, and they will occur, it's important to know how to do restructurings, and it's important that you did your credit selection correctly. We haven't seen a moment where that's really been tested, but I think in the next couple of years you will.
And are you as optimistic about the growth going forward? When I spoke with Mr. August about whether this was fueled by low interest rates or it was a transformation happening?
Yes, you have Dan and Glenn described it very accurately. You have the confluence of two very powerful secular forces. One is the regulatory force on the banks that's getting them out of this business, and the other one is the private equity firms wanting very flexible credit solutions. Those two things combined have made for explosive growth, and I think it continues.
So let's go to technology, because now this is the buzzword, even here at the FII. So banks have very sophisticated credit risk models. To what extent do you think AI and big data can be used to improve underwriting and risk assessment as well in private debt?
So I want to make one 30-second comment about the market, and then I'll answer the AI question. The other piece that is fascinating is not just new issues or the capital solutions with junior capital and stranded private equity. The other growing segment, and all three of us have decades of distressed experience, is private credit is coming to distressed. For all of the debt that is stranded, not just the equity, the debt that's stranded needs to be refinanced. There's going to be liability management exercises where that debt is restructured, new capital comes in, and it really is the convergence of distressed and private credit. So another fascinating area for growth. With regard to AI, part of me is a fundamental purist investor, fundamental value investor, can't help but pause. And at the same time, you have to ask yourself, how can you use technology? We have a 14-person task force internally and are experimenting with lots of different use cases of AI. with lots of outside consultants, and on the shelf we're developing products. I'd say stage one has been really about efficiency. How do we make the process of condensing an enormous amount of information, whether it's financial information, whether it's legal information, whether it's marketing information with all the different requests that we get, how can we make our people more efficient? How can we analyze and compare the competitor set to help us give us the tools to make better decisions more efficiently? For now, as it relates to the investment judgment, again, the three of us have been doing this for many, many decades and hundreds of billions of dollars of investment. The judgment call, the ability to create alpha, I think, comes from that experience. Again, today's market, as I commented in my opening remarks, really is this evolution all the way back to the 80s of leveraged finance and private equity. And so I do believe over time we will do a lot of analytics. We use a lot of data in parts of our business to make some predictive models in the leveraged loan space. But as you get to more restructurings, higher complexity, I'm not quite there yet, but we're all super excited to see how it evolves.
Mr. Loeb, what about fintech and private credit space?
I mean, we're in structured finance for fintech companies. We were an investor in Upstart, and part of our edge as an investor in this fintech consumer lending business was being able to provide structured product financing for them. That was a very good partnership because it enhanced the value of our equity. We earned good returns on the senior parts of those capital structures. But I'm not seeing yet the sort of fintech solution. But back to your technology question, and Glenn's response is, sometimes people, I mean, I don't think there's like a magic AI bullet. It's really looking at database management, workflow management, data analytics, applying AI to those things, but they're very core kind of technology. And yes, AI has really helped in the documentation and underwriting processes and refining using language models. But for the most part, we're at the early innings, but early innings that we need to be very engaged in, because if you're not there day one, and it's happening fast. And Glenn mentioned there's a lot of off-the-shelf products too coming in. So we too are all over that as well.
I'd like to hear your point of view on that. And on another note, is it true, or is it a right question to ask, what will it take for private debt markets to be as efficient as bond markets, or we don't want it to function that way to start with?
Interesting question. Some would say the private credit market is very efficient in its own right. It doesn't require a rating. It doesn't have any real syndication risk. And you have enormous flexibility built into the documents, and sponsors take advantage of all that. What it doesn't have is a liquid market. And that liquid market is useful. We saw that in 2022 where things really fell out of bed, and people would have liked to have sold. If you have to sell a private credit exposure, your options are generally limited. That will change over time. There are credit secondary funds coming into existence. And I think that's a wonderful opportunity, by the way, because you can, as a credit secondary investor, you can go through and really exercise your understanding of the underlying credits and generate, I think, significant value. But it's not there yet, and I think it will get there. But some would say the lack of liquidity is a feature, not a bug, because that lack of liquidity, when there's no observable market price for institutional investors, means you don't have to mark the portfolio. And if you don't mark the portfolio, your observed volatility is quite low. So I think in a way, it's what some investors want. But when you get market movements and market volatility, the ability to sell or buy does come in handy.
Because our time is tight, let's go to another angle, which is the policy angle. How much of you want to comment?
I want to make one quick comment on liquidity. So I will just offer up the view that if you buy $25 million of a $300 million syndicated loan, and you want to sell $25 million because the numbers are bad, you're not going to be able to sell it. So there is actual liquidity, and there's perceived liquidity. I would put forward that when we play in a $2-3 billion deal, where there are a handful of participants, 2, 3, 4 participants in that transaction, that are incredibly experienced and knowledgeable, that actually it is easier to price that piece of paper than it is to do the $25 million piece. So again, I think there's an overemphasis on liquidity because people just like the comfort. And I will tell you, I will trade the illiquidity premium of what is generally 150 to 200 basis points for versus syndicated loans all day, all day. With regard to regulation, my 2 cents would be, the reality is there's a lot of talk about the shadow banking system. As a practical matter, the largest players have 50, 100, 200, $500 billion of capital. Unlike banks, as Dan highlighted or implied earlier, we're levered 1-to-1, 2-to-1. With leverage financing that is basically matched to what we own and does not have mark-to-market triggers versus banks that are levered 10-to-1. And so I think there'll be some talk about it. I think the bigger issue on the regulatory side is as alternative credit products start to go into the wealth channel and individual investors buy them, I think there'll be heightened review of what the packaging is, because inevitably when the markets turn down, some of those individual investors will not understand what they bought. But I think we can all try to preempt that and be ready for when and if that comes.
Well, how can central banks regulate without stifling the growth of the market or address the concerns of shadow banking?
I'll let you take that one.
You know, I think just staying out of the way, frankly. I mean, like, the private credit market is doing quite well on its own. The banking system, what the banking system had was a regulator that when things went wrong, they made sure you classified things as non-performing. But then you got periodic crises. Again, you just don't have the triggers in the private credit system. If you put a regulatory overlay on the top of private credit, I think you're messing with a good thing.
Sorry, I didn't mean to.
Go ahead.
And I'll also add, you know, most people who have private credit draw funds also have BDCs. The BDCs are registered with the SEC. They're regulated, and there are diversification requirements, industry concentration standards. If you have financing, there's all these standards. We have a better regulator than a central bank. It's called the market. And I think the investors demand a level of responsibility and diversification. And frankly, you know, we all have a really good thing going. And the goal is, unlike the equity hedge fund business that we're always in, this is a don't screw it up business. So I don't think, you know, no one's really like making crazy concentrated bets on that great deal that's, you know, to shoot. Everyone is really disciplined. So I think there's a natural, there's just a natural capital markets regulator that already exists. And there's no real desire that I'm aware of to interfere with that.
We have a few seconds left. Why don't you give me your outlook on now with the change of interest rates, how do you see the market going? And since you are here in Saudi Arabia, by the way, what kind of interest are you seeing in the region as well?
What kind of what?
What kind of interest are you seeing in the region for the
private credit
yeah.
or to invest?
Yeah.
We're seeing it actually both ways. There's a lot of interest probably from family offices. People like the high yields. They like the option to receive current cash distributions. And we're also starting to look at some private credit opportunities. Most of what we have is regulated, required to invest in the US, but on the private credit, structured credit side, we're starting to look in the region.
Well, we're getting a big timeout, so I'm just grateful to be here. Lots of interest, certainly from the region, because they're attracted to the risk-adjusted returns, and appreciate the opportunity.
I want to thank you very much for joining us for this panel. We will continue with the conversation on private credit on another 20-minute panel, but we have, for technical issues, we're going to go down off stage, and I will come back in a minute. Please bear with us. Thank you very much.
Thank you. That's great.